Preparing for a Centrica FP&A Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to join Centrica as an FP&A analyst? I want to join Centrica because FP&A here connects financial analysis with essential customer services and the energy transition. The role would let me combine modeling, forecasting, and communication while supporting decisions in a commercially complex environment affected by regulation, weather, commodity prices, and customer demand. I am particularly attracted to the opportunity to explain performance clearly to operational stakeholders, challenge assumptions constructively, and help management allocate resources towards sustainable growth and reliable customer outcomes. While answering, connect your analytical skills to Centrica's energy, services, customer, and transition priorities. Show interest in business partnering, explain why the role fits your experience, and demonstrate awareness of the company's operating environment. Question 2. What does FP&A contribute to a business like Centrica? FP&A turns financial and operational data into decisions. In a business like Centrica, that means coordinating budgets, updating forecasts, analyzing variances, and translating drivers such as customer numbers, energy volumes, pricing, weather, and labor costs into management insight. Accounting explains what has happened under reporting standards. FP&A explains why it happened, what may happen next, and what management can do. Strong FP&A therefore combines financial discipline with commercial curiosity and practical business partnering. Make sure to cover planning, forecasting, performance analysis, decision support, and communication. Distinguish FP&A from accounting, then explain how it helps management understand drivers, risks, trade-offs, and actions across energy and services businesses. Question 3. How would you build an annual budget for a Centrica business unit? I would begin with strategic guidance, historical performance, and agreed assumptions for volumes, pricing, inflation, headcount, investment, and external risks. I would then build a driver-based model with business owners, separating controllable and non-controllable items. After consolidating submissions, I would challenge unusual movements, test downside and upside cases, reconcile profit with cash and balance sheet effects, and document assumptions. Finally, I would present a clear budget bridge and secure accountability for each major driver. In your answer, talk about the timetable, strategic assumptions, bottom-up inputs, driver-based modeling, challenge sessions, consolidation, scenario testing, and approval. Mention alignment between operational plans, financial targets, cash, and risks. Question 4. How do you approach monthly management reporting? My monthly process starts with validating actuals, mapping them to the latest forecast and budget, and investigating material movements. I would analyze both financial variances and operational drivers, such as customer churn, engineer productivity, unit costs, or energy volumes. I would discuss findings with budget owners before finalizing commentary, distinguish timing from structural issues, and highlight forecast implications. The output should be concise. What happened, why, whether it will persist, and what action is required. Be sure to mention data validation, actual versus budget analysis, business driver commentary, forecast implications, materiality, deadlines, and stakeholder review. Emphasize concise communication that distinguishes facts, causes, risks, and recommended actions. Question 5. What is a driver-based forecast, and how would you use one at Centrica? A driver-based forecast links financial results to operational factors that management can understand and influence. For example, revenue might reflect customer numbers, retention, tariffs, usage, and weather, while services costs could depend on jobs, engineer productivity, labor rates, and materials. I would identify the strongest relationships, build transparent assumptions, and update them as evidence changes. This approach improves forecast accuracy and makes conversations more actionable than applying broad growth percentages to historical numbers. Focus on linking financial outputs to operational variables rather than simply applying percentage changes. Use relevant examples such as customers, consumption, tariffs, service jobs, engineers, labor rates, weather, and commodity prices. Question 6. How would you explain a significant budget variance to a non-finance manager? I would first quantify the variance and express it in operational terms. For instance, if service costs are above budget, I would separate higher job volumes, lower productivity, price inflation, and one-off items rather than simply reporting an adverse percentage. I would confirm the analysis with the operational owner, explain which elements are timing-related or structural, and show the forecast impact. I would finish with specific actions, owners, and a date for reassessment. In your answer, cover clarity, materiality, root cause analysis, operational language, separating timing from permanent effects, and agreed actions. Avoid jargon and show how you would confirm the explanation with the owner. Question 7. What is the difference between a budget, forecast, and long-term plan? A budget is an approved financial plan for a defined period and usually provides targets and accountability. A forecast is the latest expected outcome based on current information, so it should change when assumptions change. A long-term plan describes strategic direction, investment, capital needs, and value creation over several years, usually with less monthly detail. I would use all three together. The budget measures performance, the forecast supports decisions, and the long-term plan tests strategic consistency. Make sure to distinguish purpose, timing, flexibility, detail, and accountability. Explain how the three outputs connect, and note that a forecast should reflect the latest unbiased view rather than preserve the original budget. Question 8. How would you forecast revenue in an energy or services business? I would forecast revenue by business line because the drivers differ. Energy revenue could reflect customer numbers, acquisition, churn, consumption, tariff changes, seasonality, and weather. Services revenue might depend on installed customers, contract renewals, job volumes, pricing, and completion timing. I would reconcile the forecast to recent actual trends, use cohort or run rate analysis where appropriate, and test scenarios for weather, regulation, commodity conditions, and customer behavior. The model should make every major assumption visible. Discuss segment-specific revenue drivers, customer cohorts, volumes, pricing, seasonality, churn, renewals, jobs, and timing. Mention reconciliation to actuals and scenario analysis for uncertainty around weather, regulation, and market conditions. Question 9. How would you analyze gross margin at Centrica? I would decompose gross margin into price, volume, mix, and cost movements. For an energy activity, I would consider customer mix, consumption, tariff changes, wholesale or procurement costs, hedging effects, and regulatory charges. For services, I would examine job pricing, labor, materials, productivity, and contract mix. I would reconcile the bridge to the ledger and latest forecast, distinguish timing from sustainable performance, and explain which levers management can use to protect margin. While answering, cover price-volume mix analysis, input costs, hedging or procurement effects, customer mix, operational efficiency, timing, and reconciliation to reported results. Explain how margin analysis informs pricing and forecasting decisions. Question 10. How do weather and seasonality affect financial planning for Centrica? Weather can materially influence energy demand, especially heating-related consumption, while seasonality affects customer contacts, service volumes, and working capital. I would analyze historical relationships between weather indicators and volumes, establish a normalized baseline, and model warmer and colder scenarios rather than relying on one-point estimate. I would also consider operational capacity and customer affordability effects. Monthly reporting should separate genuine commercial performance from weather-driven movements so management can respond appropriately. Be sure to mention demand sensitivity, heating patterns, historical normalization, scenario ranges, working capital, customer behavior, and operational capacity. Explain how you would avoid presenting one weather assumption as a certainty. Question 11. How would you build a scenario analysis for rising energy costs? I would establish a base case using current market assumptions, procurement positions, customer volumes, pricing, and regulatory inputs. Then I would stress key variables, such as wholesale costs, demand, bad debt, churn, and policy changes, individually and in combinations. I would quantify effects on revenue, margin, cash, and liquidity, while reflecting hedging or contractual protection where relevant. I would present ranges, probability-informed commentary if available, and practical mitigation options rather than only showing sensitivities. Focus on defining the base case, selecting relevant sensitivities, modeling customer and margin impacts, considering hedging and regulatory responses, and presenting decision-useful outputs. Include clear assumptions, time horizons, and management actions. Question 12. What KPIs would you monitor for Centrica's energy and services operations? I would select KPIs that connect customer outcomes, operations, profitability, and cash. Depending on the business, these could include customer additions and churn, energy volumes, revenue, gross margin, EBITDA, cost to serve, complaints, collections, bad debt, service completion times, engineer productivity, first-time fixes, safety, and cash conversion. I would avoid a dashboard of disconnected numbers and instead show relationships, such as whether improved retention supports lifetime value or whether productivity gains protect service margins. In your answer, combine financial and operational KPIs, revenue, margin, EBITDA, cash conversion, customer numbers, churn, complaints, service completion, productivity, bad debt, safety, and strategic investment measures. Question 13. How would you improve a forecast that has consistently missed actual results? I would begin with a forecast accuracy review by line item and driver, identifying whether errors come from bias, timing, weak assumptions, poor data, or unexpected events. I would compare forecast versions with actual outcomes, involve operational owners, and remove unsupported precision. I might introduce driver-based assumptions, leading indicators, and explicit scenarios, then track forecast error monthly. The objective is not to defend the old model, it is to create a transparent process that learns quickly and improves decision quality. Make sure to cover bias diagnosis, driver review, forecast versus actual tracking, data quality, stakeholder challenge, timing, scenario ranges, and model simplification. Show that accountability matters without becoming defensive. Question 14. Tell me about a time you found an error in financial analysis. In a prior analysis, I noticed that a monthly cost trend did not reconcile with the underlying transaction listing. I traced the issue to a duplicated import caused by a spreadsheet range extending beyond the source data. I corrected the model, quantified the effect, informed my manager and affected stakeholders, and reran the analysis before the report was issued. I then added validation checks and protected input ranges. That experience reinforced that speed matters, but reliable outputs and transparent escalation matter more. Be sure to structure the example around context, detection, investigation, correction, communication, and prevention. Emphasize control-minded behavior, professional escalation, and the impact on decisions or reporting. Question 15. How do you ensure accuracy when working with large datasets and Excel models? I use a controlled. Discuss structured data preparation, reconciliations, formula controls, version management, reasonableness checks, audit trails, peer review, and separation of inputs, calculations, and outputs. Mention Excel and relevant analytical tools honestly. Question 16. Which Excel functions and tools are most useful in FP&A? I commonly use SUMIFS, XLOOKUP, index match, IFERROR, date functions, and logical formulas for model construction and analysis. Pivot tables and charts help me investigate trends quickly, while Power Query can standardize recurring data preparation. For larger datasets, I am comfortable learning or using SQL and Power BI where appropriate. I also build checks around totals, missing mappings, and period cutoffs. The goal is not sophisticated formulae for their own sake, but reliable, repeatable analysis. Mention functions relevant to aggregation, lookups, dates, error handling, and sensitivity analysis, alongside pivots, Power Query, charts, and controls. Explain that tool choice should improve transparency, repeatability, and decision speed. Question 17. How would you partner with an operational manager who challenges your forecast? I would first understand the manager's operational perspective and clarify which assumptions differ. Then I would compare evidence, such as customer trends, staffing plans, job volumes, market data, or historical conversion rates, rather than debating headline numbers. If uncertainty remains, I would model both views and show the financial consequences. We would agree the most credible base case, document sensitivities and ownership, and revisit the assumptions as new evidence emerges. Constructive challenge should strengthen the plan, not damage the relationship. In your answer, emphasize listening, shared definitions, evidence, driver-level discussion, respectful challenge, scenario testing, and documented agreement. Show that business partnering is collaborative rather than finance imposing a number. Question 18. How would you evaluate a proposed cost-saving initiative? I would establish a clear baseline and define whether the proposal reduces unit cost, activity, headcount, supplier spend, or another driver. I would model implementation costs, timing, one-off charges, recurring benefits, taxes, cash effects, and any service or customer risks. I would assign an owner and create a benefits tracker linked to actual performance, not just an estimate. I would also check that savings are incremental, realistic, and not counted elsewhere in the plan or forecast. Focus on baseline definition, gross versus net savings, implementation costs, timing, one-off versus recurring benefits, operational risks, customer impact, and ownership. Include tracking benefits through actual results and avoiding double counting. Question 19. How do profit and cash flow connect in FP&A? Profit and cash are connected but differ because accounting recognition and cash timing are not identical. A profitable period can consume cash through receivables, inventory, deposits, CapEx, tax, or supplier timing, while depreciation reduces profit without using current cash. I would bridge EBITDA or operating profit to operating cash flow, then include working capital, capital expenditure, interest, and tax. For Centrica, customer collections, commodity payments, and investment timing could be especially important to liquidity planning. Make sure to explain that profit is not cash, then cover working capital, CapEx, provisions, non-cash items, timing, debt, tax, and customer collections. Link profit forecasting to liquidity and funding decisions. Question 20. What is working capital, and which drivers would you monitor? Working capital represents funds tied up in short-term operating balances, particularly receivables, payables, inventory, accruals, and customer-related balances. I would monitor billing accuracy, collections, overdue debt, payment plans, supplier terms, purchasing patterns, accrual quality, and seasonal movements. I would bridge actual balances to forecast and investigate whether changes reflect timing, growth, operational weakness, or accounting estimates. This analysis helps management protect liquidity without harming customer service or supplier relationships. Discuss receivables, payables, inventory, accruals, customer balances, billing, collections, supplier terms, and seasonality. Explain how operational decisions affect cash and how you would distinguish timing movements from structural deterioration. Question 21. How would you assess a capital investment proposal? I would assess the proposal's strategic fit first, then model incremental cash flows rather than allocated historical costs. The model would include CapEx timing, operating savings or revenue, working capital, tax, useful life, terminal assumptions, implementation risk, and ongoing maintenance. I would calculate NPV and IRR, use payback as a supporting measure, and stress key assumptions. Approval should include clear milestones and post-investment reviews comparing realized benefits with the original business case. In your answer, cover strategic rationale, incremental cash flows, CapEx timing, operating benefits, risks, NPV, IRR, payback, sensitivity analysis, funding, and post-investment performance tracking. Question 22. How would you handle a last-minute request for senior management reporting? I would clarify the decision the report needs to support, the required deadline, scope, and level of precision. I would use the most reliable available data, prioritize material drivers, and avoid creating false accuracy under time pressure. I would state assumptions and limitations clearly, provide a concise executive summary, and maintain a version of supporting calculations. Before sending, I would perform key reconciliations and sense checks, then offer to refine the analysis when complete data becomes available. Be sure to mention clarifying the decision need, prioritizing material information, using validated sources, stating limitations, communicating timing, and performing a final quality check. Demonstrate calm judgment under pressure. Question 23. What financial risks are particularly relevant to Centrica? Relevant risks include wholesale energy volatility, weather-driven demand, regulatory intervention, customer affordability and bad debt, operational disruption, cyber threats, liquidity requirements, and the execution risk of transition investments. I would quantify risks through sensitivities and scenarios, monitor leading indicators, and distinguish mitigated from unmitigated exposure. FP&A should connect risk analysis to forecast and cash consequences, communicate emerging issues early, and help management evaluate trade-offs between resilience, customer outcomes, investment, and returns. Focus on commodity prices, weather, regulation, customer affordability, bad debt, operational execution, cyber risk, liquidity, transition investment, and reputational exposure. Explain how FP&A identifies, quantifies, monitors, and escalates those risks. Question 24. How do you prioritize competing deadlines in an FP&A team? I rank tasks by business impact, deadline criticality, dependencies, and risk if delayed. A board or regulatory submission would normally take priority over a lower impact ad hoc request, but I would confirm expectations with my manager and stakeholders. I break work into essential and optional outputs, reuse validated templates, and communicate realistic timings early. I never hide a quality risk. If trade-offs are necessary, I explain them, agree the revised scope, and preserve controls around material information. In your answer, discuss business impact, regulatory or board deadlines, dependencies, effort, data availability, stakeholder communication, and quality controls. Show how you would renegotiate priorities rather than silently compromising important work. Question 25. What would success look like for you in your first 6 months at Centrica? In the first 6 months, I would aim to understand Centrica's business lines, reporting calendar, systems, controls, and key operational drivers. I would become dependable in monthly reporting and forecasting, produce clear variance commentary, and build strong relationships with budget owners. Once I understood the process, I would identify a practical improvement, such as automating a recurring reconciliation or strengthening a forecast driver. Success would mean accurate outputs, trusted challenge, faster insight, and clear evidence that my work supports better decisions. Make sure to cover learning the business model, systems, reporting calendar, key drivers, stakeholder relationships, forecast quality, process improvements, and dependable delivery. Set measurable but realistic expectations for a new analyst. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.